Picture two families, both worth $200 million. The first family made its money 3 years ago, a tech exit, a lucky trade, a viral brand. The money sits in a bank account with one signature on it, the founder's. There's no plan for what happens if he gets hit by a bus tomorrow. His kids know the number in the account. They don't know what it's for. The second family made its money 4 generations ago. Nobody alive today built the fortune. And yet, there's a 14-page document that governs how money leaves the family. There's a quarterly meeting that happens whether anyone wants to attend or not. There's a professional staff whose only client for 80 years has been this one family. There's a rule about what a 19-year-old is and isn't allowed to touch. The first family has money. The second family has an institution. And that difference, not the size of the balance, not the address of the house, not the school on the sweater, is the single most reliable predictor of whether wealth survives past the person who made it. Today, we're going inside that machinery. Not the myth of old money, the actual mechanics, the constitutions, the councils, the offices, the legal scaffolding that turns a pile of money into something that behaves less like property and more like a government. By the end of this video, you'll understand why old money families don't talk about our money. They talk about the family, as if the family itself were the asset. And the money is just what the institution happens to hold. If you're new here, this channel goes past the aesthetic of generational wealth and into the actual architecture behind it, the legal, financial, and psychological systems most people never see. Subscribe if that's what you came for, because we're about to get very specific. 1. The core distinction: wealth as event versus wealth as institution. Let's start with the mental model because everything else in this video builds on it. Most people who acquire wealth treat it as an event, a liquidity event, a sale, an inheritance, a windfall. Something that happened to them at a moment in time and now belongs to them as an individual. The natural instinct that follows is ownership thinking. This is mine. I earned it. I decide what happens to it. And when I'm gone, it'll be divided up like any other asset in an estate. Old money families reject that framework almost entirely, not out of sentimentality, but because they've watched ownership thinking fail generation after generation in painfully predictable ways. Instead, they adopt what sociologists studying family enterprise call institutional wealth logic. The wealth isn't mine, it's the family's. And the family isn't just the people alive right now. It includes the ancestors who built it and the descendants who haven't been born yet. The living generation isn't an owner. It's a trustee, in the literal and figurative sense, holding something on behalf of people who came before and people who haven't arrived. This single reframe changes almost every decision downstream. If wealth is an event that happened to you, you optimize for your own lifetime. Comfort, status, enjoyment, maybe a legacy gift at the end. If wealth is an institution you're a temporary steward of, you optimize for durability across time horizons longer than any one life. You build governance the way a nation-state builds a constitution, not because you expect to personally need every clause, but because you know someone eventually will, and you won't be there to write it for them in the moment. There's a phrase family governance consultants use with clients. You don't own the wealth, you're renting it from your grandchildren. It sounds like a slogan, but it's functionally how the legal structures we'll cover in this video actually work. Trusts that won't fully distribute for 80 or 100 years. Family compacts that bind decisions no living member made. This is also where the widely quoted shirt sleeves to shirt sleeves in 3 generations statistic comes in. The idea that the vast majority of family wealth is gone by the 3rd generation. You'll see this cited constantly in wealth management marketing, often as a hard 70 to 90% failure rate. We need to flag this clearly. The research behind this number is methodologically contested. Much of it comes from surveys of wealth advisors' perceptions of client families rather than longitudinal tracking of actual family balance sheets, and wealth is defined inconsistently across studies, sometimes meaning the specific operating business, sometimes total net worth, sometimes just the original fortune's real value adjusted for a growing number of heirs splitting it. What's better supported is the underlying mechanism. Without institutional structure, concentrated wealth fragments across generations through division among more heirs, lifestyle inflation, and the simple absence of coordination. The statistic may be shaky. The mechanism it's describing is real, and it's exactly what institutional structures are engineered to interrupt. If you've ever wondered why some families are still wealthy after 150 years and others burn through a fortune in a decade, the answer is almost never better investing. It's structure. Hit like if you want more of these mechanism breakdowns and drop a comment. Does your family talk about money as ours or as mine? That one word changes everything, and I want to see your answers. 2. The family constitution. Writing down what's not allowed to be forgotten. If the mental shift is, wealth is an institution, the first physical artifact of that shift is usually a document called a family constitution, sometimes called a family charter, a family creed, or a statement of family values and governance. This is not a legal document in the way a trust deed is legally binding. In most jurisdictions, a family constitution has no direct enforcement power in court. And that's exactly what makes it interesting. Families spend enormous time, money, and emotional energy writing something that isn't, strictly speaking, required to work. They build it anyway, because its function isn't legal. It's cultural infrastructure. A typical family constitution. And we've reviewed the structure of several public examples from family enterprise consulting literature. Covers territory like the family's mission and core values, often traced explicitly back to the founder's original principles. Criteria for family membership, by blood, by marriage, by adoption, and what rights each category carries. Policy on family members working inside family businesses. Qualifications required, whether outside work experience is mandatory first, compensation set at market rate rather than family rate. Rules for family council composition, how often it meets, how decisions get made, and by what voting threshold. Conflict resolution procedures, literally, a pre-agreed process for what happens when family members disagree, so a dispute doesn't have to invent its own rules in the heat of the moment. Philanthropic commitments and how giving decisions get made. Education requirements before a family member gains any economic or governance rights. Here's the mechanism worth understanding. A constitution works because it moves decisions from emotionally loaded moments to emotionally neutral ones. Deciding, should cousin Marcus get a job at the family company even though he's underqualified, is an incredibly fraught conversation to have about Marcus specifically, in real time, with Marcus's mother in the room. Deciding, what are our general employment criteria for family members, is a calm, abstract policy conversation that happens years before any specific Marcus exists to make it personal. The Constitution front-loads the hard conversations into moments of low emotional stakes, so that high-stakes moments later just require enforcement, not negotiation. Consider a composite case. Call this the Hartwell family, a fictionalized composite drawn from patterns common across multi-generational manufacturing dynasties. 3 generations in, the family had 11 adult descendants with wildly different levels of interest and competence in the family's industrial business. 2 wanted in. 4 wanted nothing to do with it and just wanted dividends. 5 were somewhere in between. Without a constitution, that's a recipe for permanent resentment. The ones working feel exploited by the ones collecting checks, and the ones collecting checks feel shut out of decisions about money that's technically theirs too. With a constitution written a generation earlier, the rules were already set. Non-employed family members receive a defined dividend policy and quarterly reporting, but zero say in operational decisions. Employed family members are compensated at market rate, evaluated by a mixed board, including non-family directors, and can be removed like any other employee if performance doesn't hold up. Nobody had to invent fairness in the moment of maximum tension. Fairness had already been legislated. This is also, frankly, why families revisit and rewrite these documents every 10 to 20 years. A constitution frozen from 1975 governing a family with same-sex marriages, blended families from divorce and remarriage, and members living on 3 continents will crack under pressure it was never designed for. The healthiest family institutions treat the Constitution the way functioning democracies treat their founding documents: sacred in principle, amendable in practice. 3. The family office. Building a permanent civil service. If the Constitution is the family's legal cultural code, the family office is its civil service, the standing bureaucracy that exists to execute the code whether or not any given family member is paying attention that week. We've covered family offices in depth on this channel before in our long-form breakdown of the family office mindset. So if you haven't seen that video, it's worth watching alongside this one. But here we're focused specifically on why the existence of a permanent office is itself an institutional signal, separate from what it does day to day. A single family office typically employs a mix of specialists: a chief investment officer managing the portfolio across asset classes, tax attorneys structuring around multiple jurisdictions, estate planning counsel maintaining and updating trust structures, a controller handling household and entity-level accounting, sometimes a dedicated philanthropy director, and increasingly a family governance specialist whose entire job is facilitating the human side, mediating disputes, running education programs for rising generation members, and keeping the family constitution a living document rather than a dusty one. The institutional function this serves is continuity of institutional memory. Individual family members die, divorce, have breakdowns, go through decades of disinterest and then sudden re-engagement. A family office staff, by contrast, persists. The same trust attorney who structured the original Dynasty Trust in 1987 may still be advising the family in 2026. And even after that attorney retires, the firm's files and relationship persist. This means a 19-year-old heir walking into their first family council meeting isn't improvising against professionals who are also new to the situation. They're stepping into decades of accumulated context that the office holds even when no single family member does. There's a threshold question every family eventually confronts. Is a dedicated single-family office worth the cost? Industry benchmarks generally suggest the overhead only makes economic sense somewhere north of $100 to $250 million in investable assets, which is why a multi-family office, a shared staff serving several unrelated wealthy families, is the more common vehicle below that threshold, and why some families deliberately delay building a dedicated office structure until they're confident the wealth base can support the recurring cost of the institution itself, not just the investments it manages. This is exactly the kind of infrastructure most people never see because it's designed to be invisible. No branding, no public presence, sometimes not even a listed phone number. If this kind of hidden architecture is what you come here for, subscribe and turn on notifications, because we go inside a different piece of this system every week. And if you want the Constitution and family office topics linked directly, I'll drop that video in the description and pinned comment. 4. Trusts. The legal skeleton that outlives everyone in the room. Underneath the Constitution and the office sits the actual legal skeleton, the trust structures that hold the assets and dictate, with binding legal force, what can and can't happen to them. Here's the conceptual leap that makes old money thinking different from ordinary estate planning. A basic will transfers property to a person, at which point that person owns it outright and can do whatever they want. Spend it, gift it, lose it in a divorce, mismanage it. A dynasty trust, by contrast, never fully transfers ownership to any single generation. Assets are held in trust for the benefit of a beneficiary, managed by a trustee bound by a legal document called a trust instrument, and depending on the jurisdiction, this structure can be built to last many decades. In states that have abolished or extended the traditional rule against perpetuities, some trusts are drafted to run for centuries, or, in a handful of jurisdictions, without any fixed end date at all. The practical effect: no single generation ever has the unilateral legal power to blow up the fortune. A beneficiary might receive income distributions, might have use of a trust-owned property, might even have some discretionary access negotiated with the trustee, but they typically cannot simply liquidate the trust's core holdings and walk away with the principal. The institution's assets are legally insulated from any one human's bad decade, bad marriage, or bad judgment. This is also the backbone of the buy, borrow, die strategy this channel has covered before. Rather than selling appreciated assets and triggering capital gains tax, families borrow against trust, held assets for liquidity. Let the assets continue compounding and passing through generations with basis adjustments at death, and structure the whole chain so the institution's balance sheet keeps growing even as individual generations draw against it for lifestyle. A useful mental model here is the difference between a trust and a private trust company, PTC, something we've built a full episode around previously. A standard trust names an individual trustee or an outside corporate trustee, like a bank's trust department. A private trust company is a legal entity the family itself owns and controls, chartered specifically to act as trustee for the family's own trusts. This matters institutionally because it moves fiduciary control from an outside institution, subject to that bank's staff turnover, policy changes, and priorities, into a structure the family governs directly, typically through a board that mixes family members with outside professional directors. It's the difference between renting institutional infrastructure and owning it outright. Fact-check flag for editorial review. Perpetuity rules vary enormously by jurisdiction and change periodically through legislation. Verify current status in whichever state or country is referenced on screen before publishing, and avoid stating a specific "trusts can legally last X years" figure without a jurisdiction attached. 5. Education. As institutional onboarding, not just schooling. Here's a distinction that surprises people. In old money families, education often refers to two entirely separate tracks that run in parallel: academic education and what family governance literature calls rising generation education, or heir preparation. The second track has almost nothing to do with degrees. Rising generation education programs, run either informally by parents and grandparents or formally through the family office's governance staff, typically build competency in a specific sequence. Financial literacy first, reading a balance sheet, understanding what a trust actually is and isn't, understanding the family's specific asset structure. Then, governance literacy. How the family council works, what the Constitution says, how decisions actually get made. Then, often last and most gradually, actual authority, controlled exposure to real decision-making, frequently starting with a philanthropic budget a young family member gets to allocate under supervision, precisely because a philanthropic mistake costs relationships and reputation, but doesn't threaten the balance sheet the way a bad investment decision would. We've discussed the specific mechanism of the age 30 power threshold in a previous video. The widespread pattern of trusts and family bylaws that withhold meaningful economic control until a beneficiary reaches a set age, frequently around 30 to 35, sometimes staged across multiple ages with partial distributions. The institutional logic isn't distrust of the individual specifically. It's an acknowledgement, baked into legal drafting decades in advance, that early adulthood is statistically the highest risk window for poor financial judgment, relationship instability, and susceptibility to exploitation, and that a structure protecting against that risk needs to be in place before anyone can know whether a specific 22-year-old will need the protection. This is also where the pattern we've called the stealth wealth audit connects directly to institutional education. Families deliberately undersignal wealth to children specifically so that the values and financial competency get built before the psychological weight of "I am extremely wealthy" gets added on top. A teenager who grows up believing the family is comfortable but not flashy, works a summer job because it's expected rather than optional, and only later learns the true scale of the family's structures, tends to arrive at real authority with habits already formed. A teenager who grows up knowing exactly how much money exists, with no habits built first, tends to arrive at that same authority far more fragile. I want to know from this audience specifically, were you raised knowing your family's real financial picture, or was it something you found out about later, through a will, a conversation, or piecing it together yourself? Drop it in the comments below. I read every one of these, and some of the best future video topics on this channel have come directly from what you share here. 6. The Family Council and Assembly. Governance as recurring ritual. A constitution written once and a trust drafted once are static. What keeps an institution alive is recurring ritual, and for old money families, that ritual is the family council and, at larger scale, the family assembly. A family council is typically a smaller elected or rotating body, often somewhere between 5 and 15 members, that meets regularly, sometimes quarterly, to handle governance business, reviewing the family office's performance, approving major policy changes, hearing disputes, and preparing recommendations for the full family assembly, which might only convene annually and can include every adult family member, sometimes numbering in the dozens or, in the largest and oldest dynasties, the hundreds. The institutional function here is less about any single meeting's agenda and more about what organizational theorists call ritualized continuity. The meeting happens on the calendar whether or not there's a crisis, which means the muscle of governance stays exercised during calm periods, so it's already strong when an actual crisis arrives. Compare this to a family with no such ritual. The first time they ever have a structured conversation about the money might be at a parent's funeral, under maximum grief and maximum stakes, with zero practice process for handling disagreement. old money families deliberately practice governance under low stakes, so the skill is already built before the moment it's actually needed. These gatherings also serve a quieter function tied to what we've previously called the family's silent currency, social capital. An annual family assembly isn't just a business meeting. It's frequently structured around a multi-day gathering with shared meals, sometimes at a family compound or historic property, explicitly designed to keep second cousins, who might otherwise be strangers, meaningfully connected to one another. This matters institutionally because a fractured, disconnected family is far more vulnerable to internal conflict over money. People fight far more bitterly with relatives who feel like strangers wearing a familiar last name than with relatives they've maintained genuine relationships with across decades. 7. Philanthropy. As the institution's identity engine. Last mechanism, and one of the most underappreciated, philanthropic structures, private foundations, donor-advised funds, family philanthropic committees, function as far more than tax-efficient giving vehicles. Their identity infrastructure. Here's the mechanism. A family operating business eventually gets sold, or a family's original industry becomes obsolete. Steel, rail, an outdated manufacturing process. When that happens to a family with no institutional identity beyond the business itself, the family can genuinely fracture, because the thing that organized their shared purpose is gone. Philanthropic institutions solve this by giving the family a permanent, purpose-driven reason to keep convening that has nothing to do with whether any particular operating business still exists. A family foundation's board seats become a training ground for governance skills in a lower-stakes environment than the operating business or investment portfolio. A 24-year-old can meaningfully sit on a foundation grant committee and learn fiduciary responsibility, budget discipline, and how to disagree productively with relatives in a setting where the downside of a mistake is a suboptimal grant rather than a threatened family fortune. And the foundation's mission, often traced explicitly back to the founder's original values, sometimes literally quoting founding family members in mission statements, becomes a mechanism for keeping fourth and fifth generation members psychologically tethered to a founder they never met, translating "we are wealthy" into "we stand for something specific," which is a far more durable organizing identity across generations than a balance sheet number ever is. We go deep on exactly how these giving structures work, the legal vehicles, the tax mechanics, and the reputational engineering behind them, in our video on Freeports and the invisible fortress of old money asset protection. If today's video is resonating, that one's the natural next stop. So let's bring this all the way back to the opening comparison. Two families, both worth $200 million. The difference was never really the number. It was that one family's wealth exists as an event in an individual's life, and the other family's wealth exists as an institution with its own continuity, independent of any single life inside it. A constitution that pre-negotiates the hard conversations before anyone's angry enough to make them badly. A family office that remembers what no single relative can be trusted to remember. Trusts that legally prevent any one generation's worst day from becoming the whole family's last day. Education that builds judgment before it hands over power. Councils that practice governance when nothing is at stake. So the skill is ready when everything is. And a philanthropic identity that gives the family a reason to stay a family long after the business that made them rich has become a footnote. None of this is about the money being bigger. It's about the money being organized differently, organized the way institutions organize themselves, rather than the way individuals do. if this kind of mechanism level breakdown is what you're here for. This channel exists specifically for people who are done with the aesthetic version of old money content and want the actual architecture underneath it. Subscribe. Check the pinned comment for the full family governance and family office series in order, and I'll see you in the next one. This isn't hidden, it's just never taught.